Hey everyone, Chris Lopez here, and welcome back to another deal analysis episode. So, today we're going to be talking about a 15 unit apartment building that we helped a client buy in Denver. So, my co host today is Preston Newberry, and Preston is an agent with me at Earcast Real Estate, and he and I helped put this deal together. Preston, glad to have you on the show.
Thanks for having me back again, Chris. I really enjoy digging into these deals that we get to look at and analyze with all of our clients.
Yeah, especially this one. This one, we got a few things to talk about on this one. So, to give everyone the backstory on here, this property closed quarter 4 2019, and probably back in quarter 3 2019, an out-of-state investor reached out to me. He was selling at the time one of his apartment buildings in Los Angeles. So I think it was like a 10 or 12 unit apartment building out there. And then he wanted to sell it, conduct a 1031 exchange, and then bring the money to Denver. And the reasons he wanted to bring the money to Denver was Denver has better cap rates and strong upside. So he wanted a better cap rate. And basically, he was selling his apartment building around like a low 3 cap rate and buying into a low 5 cap rate here in Denver. So, basically a 2-point spread on the cap rate, which is pretty darn significant. The second reason he wanted to do it is just because when he retires in a few years, he plans on moving out to Denver, as some of his family's out here as well. So he wanted a better investment and also just make an alignment with where he was going to retire, and then also for his estate planning as well. So, his kids could inherit it and run it as well. So if you guys don't know the 1031 exchanges, that is where you sell a property, you follow some rules laid out by the IRS, and then you're able to take that money, put it into a new property, and not pay capital gains on those tax or on those property proceeds. So it can be a huge tax saver there, especially when we're talking about bigger properties like this. So he called me. We talked, we started getting things lined up, because a very important thing with 1031s, it really does come down to having the right team available together to work together, because we have to meet very tight deadlines. So from the day his property sold in California, whatever day it closed out there, he has 45 days to identify a new property. And that really means basically be under contract and be past, any major hurdles like the inspection items by that 45-day window. Because once that 45-day window passes, you can no longer get new properties to identify. And then from there, you have 135 days from that 45-day mark to close on the property. So with this, two things. You have these timelines you have to be mindful of, especially when you're talking about, a really large chunk of money, because this would have been a 6-figure plus capital gains bill. And then plus it's a lot more coordination, because now it's not just me and Preston, but we're in communication with the listing agent in California. We then also have to work with the 1031 Qualified Intermediary, which is a fancy name for the people that hold the money. They're basically like the trustee that holds the money, because if that money hits the investor's bank account, he owes taxes on there. But if this third-party trustee holds the money, they receive the money from the sale in California, and then they wire the money into the buy here in Denver. And then there's no capital gains owed. So it's making sure everyone's in communication, everyone's on the same page. And of course, we all have our own, rules we have to follow, and making sure everything good's to go. So we spend a lot of time coordinating on that, because the more you prep, the more you plan, the more success you have with doing these types of transactions. So Preston, talking about, let's talk about the property a little before we jump into all the details, because this was a neat one. Give us the basic rundown of the property and location. I need to go clear my throat.
Yeah, so this property is located down in the heart of Denver. Property that we really liked, because even though it was vintage, the property was built very sturdy, all brick construction, very sturdy steel and concrete landings, so very minimal maintenance. The seller of this property had owned it for about 15 years and done a lot of CapEx to this place. I mean, everything had been sorted out and taken care of. So for us, having a client that knew Denver but didn't know the ins and outs of the area, really wanted something that was in a central location, was going to give him a lot of upside, and be something that wasn't going to drain their bank accounts with a bunch of repairs and maintenance items.
Yes. And then, so the profile of this investor, as we talked about, out-of-state client, definitely has experience with apartment ownership and management. So the small buildings, the 10 to 20 unit type range, that's something he and his family, they've owned a couple over the years. And so really his primary goal was to secure a legacy asset for his family while also adding to his retirement cash flow. And with a lot of multi-units, we actually found this one through networking. I don't know the exact percentage, but way more properties percentage-wise trade off-market, so not on the MLS or LoopNet in the multi-unit world than they do in the single-family home world. So once we got word that we might be in a 1031 exchange, we started talking to everyone we know, throwing out feelers, doing some hunting for what I talked about a few minutes ago, because we have that tight deadline that we have to be considerate of. So once we know, hey, the basic timeline or the very rough timeline and the rough numbers we have, we start going out there and seeing what we can drum up, because the sooner you do it, the better. Because if you get behind the deadlines on there, it can make for a very stressful experience. And of course, we want to buy the best property we can, and not get backed up with our backs against the wall and have to buy a property when it's not ideal. So we found this one through networking. As Preston said, this guy owned it for a long time, and it made sense for him. He said, hey, sell it for this price. I can do it because I can sell it in a year or two, but I could sell it now, because he wanted to sell it and 1031 into another property. So when you get into these bigger properties, a lot of times there's a lot more of that, the friendliness in the transaction to make it work for both the seller and the buyer. So can be a very nice feature. So this is as we said, a 15 unit, and it's a 1 bedroom, 1 bathroom, not too far from like St. Joe's Hospital down in Denver. The original price the seller was looking at was $2.7 million. Then after some negotiations and a couple things like that, we got it down to $2,615,000. So about, $85,000 less or so. So, a good chunk of money. So in addition to the location, the lower capex, and the great construction, another reason we liked it was there is an upside to increase the rents. So this building, I think it was the 50s, Preston, or 60s? When was this built? Do you recall?
50s.
In the 50s. So, most of the units had already been updated. I think like 13 out of the 15 units have been updated. So, new flooring, new cabinets, new countertops, all that stuff, but still had the original electrical system. So, it was perfectly fine, but it was just, dated and was, and definitely did not have all the voltage that newer buildings have. So the upside here was to go in there and do a whole building-wide electrical upgrade. And then from there, you're able to go into each unit and add individual washer and dryers, and then also an AC ductless mini split system. And those AC systems, those are the ones where it looks like a long rectangular bar at the top of the room. They don't have like traditional AC, but they can do AC that way. So the reason this is really interesting was because that could significantly increase the rents, and it would not take a whole lot of work, a whole lot of money to do it. Now, obviously, the electrical upgrades, I think the quotes we got, Preston, from some of our contractors, they were like, was it $50,000 to $80,000 was the range we were seeing? Do you recall?
Yeah, we were looking anywhere between $50,000 to about $85,000,
okay,
depending on the extent of some of the work, and that would include bringing in, new power from Excel. They'd run a new pole, and then upgrading all the panels, and then in turn going in and upgrading all the units as well.
And then inside the unit, one of the nice things is, great, add the washer and dryer, but then two things. You need the space, and you need to be able to then tie into the existing plumbing. Well, these had, the way the closets were configured, they were right next to the utility room. So you could take some of the closet, expand the utility room, put the washer dryer there, and then very easily, without having to go through a bunch of walls or running lots of feet of pipe, you could go out there and just tie into the existing plumbing and electric, and then plug in AC ductless. That's pretty simple as well. So do all that, and as Preston said, the quotes we heard in the electrical was like 50 to 85 grand. Of course, we got 2 or 3 quotes from a few people, and then updating each unit probably is going to be around $3,000 or so per unit with some labor and materials. So altogether, it's going to be a significant chunk of money. Doesn't have to be done right away, but at some point it can be done. But it should increase the rents by $200 to $250 a month. So a very significant rent bump. So Preston, why don't you run through the contract details since you were leading this one?
Yeah, like we talked about earlier, this came from our network and from a very experienced investor seller who was looking to do a 1031 into another property. So the nice thing about deals like this is, everybody understands we need to be flexible and, work together to get everyone to the closing and the finish line so we can all continue on with our deals. So, this one was actually pretty straightforward. We had a pretty good idea on price and what we were looking at and how the numbers all worked with where the current rents were. So that was nice. Once we got it under contract, we, of course, did our inspection. We did get the property under contract a little bit below the seller's original asking price. So when it came time to do inspection stuff, we were very cognizant of that and wanted to make sure we only, brought up anything major that needed to be handled. So, obviously a few electrical issues on the interior, some of the units, nothing major. And in the units that hadn't been updated, there were some old water heaters and old furnaces. So knowing that the buyers were going to go in at some point and rehab those units anyways, we negotiated a small credit from the seller to cover a little bit of the cost on some of that stuff, so everyone was happy.
And then for financing, our client went through CBRE and they got a non-recourse Freddie Mac small business loan. So what this is I know a lot of times we talk about Freddie and Fannie when we're buying 1 to 4 unit properties, but Freddie also does a lot of loans on apartment buildings. And so one of the reasons it's very attractive to a lot of investors is because they'll do a non-recourse loan. And the non-recourse loan is where if Preston goes out and buys this property, he does not have to personally guarantee the loan. So if I go buy a property, I bought a condo last month. I buy that condo, I am personally guaranteeing that to my name. Well, if Preston bought this apartment building, he is not personally guaranteeing his name. So if for some reason the building could, stop bringing money and he stopped making mortgage payments, they can only go after the asset and not his personal self. So they went through the Freddie loan, or they went through CBRE to get the Freddie loan. And there's usually 3 options you get, or 3 options we got: a 5-year, a 7-year, and a 10-year fixed period. And then it's adjustable rate and it's amortized over 30 years. Well, since they were looking to hold on to for a long time and rates were really, really low, they actually opted for the 10-year fixed over 30 years. And with that, it came with 3 years of interest-only payments. So their interest rate came in right around like 4.1%. And if they did a 7-year, it was something like a 3.9 or 4%. And a 5-year was like 3.7 or 3.8%. I forget the exact numbers there. Obviously, the longer you have a fixed rate, the higher the interest rate. But I mean, to me, it was just impressive that they got a 10-year fixed non-recourse loan at a 4.1% interest. So great deal there. And then at 3 years of interest only. That, 2 things. What that does is when they still have to make their loan payments, but they're only paying the interest portion and not the principal portion. So there's no principal reduction. So that means they actually save money every year, which is actually more cash flow. So it helps them build up reserves. But in their case, it's what that extra cash flow, they can use that to help fund these upgrades and therefore increase the rents and increase the value of the property. So the appraisal came in at above. Seller concessions was for $10K, as Preston said, and then no PMI and no interest rate buy down with this type of loan. So what we did here, we plugged these numbers into Joe Massey's rental spreadsheet. And now his spreadsheet is designed for 1 to 4 unit properties, as he's a residential lender. He's not a commercial lender. But the spreadsheet still works for it, other than there's a quirk or 2 in there. But we'll walk you through those. But we usually use a more advanced spreadsheet when we analyze 5 units and greater properties. But in terms of doing a deal analysis and doing it on YouTube and a podcast, it's much easier to use a spreadsheet everyone's familiar with, and you still understand the numbers. So we plugged in the 15-unit apartment building. I selected only 1 unit on Joe's spreadsheet, and that dropped down from 1 to 4, and we just put all the rents in one field. Now, Our buyers put down about 32%. And that was because they had a certain amount of money they needed to use up for their 1031 exchange. And if you don't use that money, so if Preston sold his building in LA or wherever he sold it from, for example, and he has $1 million in 1031 proceeds, if he doesn't use all that money, he'll get taxed on that money. So it's pretty common for people to put down more than 25% when they're buying an apartment building. Because, oh, great, I got an extra $100,000 laying over. Let me put that towards the property so I don't pay taxes on there. So they end up putting that out 32%. Plug in the purchase price, acquisition cost. They are higher on these apartment buildings because everything costs more because it's more labor intensive. The loan cost, the inspection, the appraisal, all that costs more. So all together it was probably just over about $30,000. Plug in the $10,000 seller credits, and all in, they were in there for about $858,000. We put the interest rate on here of 4.16% over 30 years. And then the combined rents for all 15 units is $16,529. And so that's all 15 units. Now, every unit does not have the same amount of rent on there, but all together, that's what they came out to. We plug in our 5% vacancy, 3% for rent increase, plug in a 35% effective tax bracket. One more note on the rents. I just see now in my notes that in addition to the rents, there's also $50 a month per unit in rent utility bill back for utilities on there. And Preston, these were all renting for what, like $1,000 to $1,100? Is that what they were renting for?
Yeah, some of the units that hadn't been rehabbed yet were just under $900 a month, and then units that had recently been rehabbed and rented were just over $1,000 a month. So
okay.
A little bit of a spread in the rents, but that's why the upside was so nice with this unit with this apartment building.
Yeah, that's another good point because in addition to doing the upgrades to bring up market rent, there are just some leases in place that when they become vacant or it's time to renew the lease, they could bump up the rents $50, $100 to market rent, and that's more cash flow for them as well. So going off the spreadsheet here, we said yes to property management, and we put in 8% because the actual fees are closer to 7%. Put up an extra point in there to round up for any turnovers. Now on Joe's spreadsheet, I put 0% for monthly repairs and reserves in his field on there. That's not because we're not accounting for it. We just put it lower in the line item. So the way we underwrote this, and this was per CBRE's underwriting guidelines, is they underwrite the repairs and maintenance at $800 a unit per year. So 800 times 15 units times 1 year is $12,000. And then we underwrote it also at $250 a unit per year for reserves. And that is for the longer term reserves of the capital expenditures, water heaters, roofs, that type of thing. So that comes out to $3,750 a year. Taxes on this property were $9,200. Insurance was about $4,300. The landlord is paying for water and sewer because it's pretty common here in Denver that there's one water and one sewer tap. And so that came in at just over $4,000. Trash is about just under $1,500 a year. And then all the units have individual electric and individual gas meters, which is really, really nice for these types of buildings. So the landlord only pays for the common area. And the common area is nothing. It's a couple light bulbs in the stairwells is really all the common area is. We put landscaping and snow removal at $500 a year. And, there's not going to be much areas to remove snow. And as far as landscaping, it's concrete. And, to landscape concrete's pretty darn easy. So, Preston, any comments you want to talk about there on those numbers? I think we hit them all, but did I forget anything?
No, we touched on everything there. It's pretty straightforward as far as the expenses here, and that was the other caveat to this property in particular was that it had really low maintenance expenses. As far as the trash and the electric, and the fact that everything was metered separately for electric and gas for each unit. So that was something else that was very appealing to our client.
Yeah, and I mean, as we were hunting for this, kind of taking a step back, we looked at different multi-units. We looked at some bigger buildings. We looked at some fourplexes. So we definitely looked at a couple properties. And this was by far the best we saw, and especially when taking into fact the location. And as Preston said, all the lower capital expenditure items. You typically see a lot of multi-units having a lot of deferred capital expenditures. This, other than a couple of those water heaters, had none. And a couple of water heaters for a multi-unit is definitely no big deal. So going through the numbers here, getting back to those, so that puts the annual expenses right around $52,000 a year. So you subtract the rents minus that, leaves you a net operating income of about $136,000 for the year. Now in Joe's spreadsheet, it shows a payment of about $8,600 a month. Well, that's because Joe's spreadsheet automatically calculates principal and interest. Well, the reality is that first 3 years, since this is an interest-only loan, they are only paying the interest portion of that, so they actually have more cash flow. So if you look at the return on investment quadrant, the cash flow is showing about $33,000 a year. And if you look at the lower left of it, the debt pay down is about $30,000 a year. So if you think about it this way, so let's just say, for example, my monthly payment's $10,000 a month. And normally that payment is, the first month it's $7,000 towards interest and $3,000 towards principal. Well, if I'm paying interest only, I'm really only paying that $7,000 portion of it, not that $3,000 portion. So I'm only paying $7,000, and that $3,000 a month is extra cash flow in my pocket then. So altogether, this would make closer cash flow to be, should be around $50,000 to $60,000 a year in cash flow, because you're only doing interest only the first couple of years. So obviously that's really good cash flow, and that's what they're going to use to help fund some of these upgrades to increase future cash flow on the rental properties. So looking at all this, it's a 5.2 cap rate, which is exactly what you expect for this part of location and this type of property. And so we're actually really happy with this, because a lot of properties we looked at, they were like either same cap rate but a lot more deferred maintenance and no upside, or even lower cap rates. So overall, looking at small apartment buildings around Denver, this was an above average deal that we were really, really happy to see and look at. And, Preston, one thing popped in my mind here as I was reviewing this, because this was a longer close process because of the 1031 and also going through the non-recourse loan with CBRE. You dealt with a very fun zoning curveball, and I'm saying this with a smirk on my face. So remember that one, Preston?
I was wondering if we were going to touch on that, Chris.
Why not? Bring up some memories, man.
I do remember this one, and it gave us definitely a little bit of a heart palpitation. As we were going through all the lending guidelines and everything with CBRE and Chris that helped us out with this deal over there, it came to light that Denver had recently done a few years back a new zoning overlay, particularly in this part of town, as they're kind of dealing with some of the congestion and building things that are happening in town. And one thing that popped up was the fact that this property had been rezoned to not allow multifamily units. So obviously this came up during the discovery process with the lender and their legal team. And, that's something else that's a little bit different with the commercial side, is there's a lot more legal people involved, as far as lawyers and attorneys and things like that. So as they're reviewing everything, this came up and ended up having to go down to the city and go through all the previous property records and make a case to get them to give us a variance and a certificate from the city that would appease the lender, so that if anything ever happened to the property, they would be allowed to rebuild and keep the same property type that was there. So definitely something that we hadn't dealt with before, but ended up making everything come out okay, and everybody was happy, and we were able to continue on to the closing table. But that one definitely threw us for a curveball.
Yep. But that's why it's always good. I mean, we knew who to call. We got in touch with the Lord, and he's like, oh, yeah, deals with it all the time, and got it handled. Obviously, was not a little extra stress for those couple of days there, but that's just, there's always something, it seems, that pops up when you're doing these bigger transactions, and that's just par for the course and to be expected. And you got to understand, the lenders, they have to require that, because as Preston said, if something happened in the building, let's just say it burned down, well, if they can't rebuild a 15-unit apartment building there, how are they going to get their rents to pay back the mortgage? If it's zoned a single-family home at this point, great. If they sell it to go build a single family home, that does not bring in the same numbers as building a small apartment building on there. All right, so to wrap this up, talking about going back to the value upside here, I want to give you an idea because I gave you the numbers that probably close to about $100,000 to do all that work, maybe a little bit more depending on how things shake out. And if their estimates are like mine, this definitely will be a few dollars more. But just say $100,000 for easy math. And then, according to the property manager, that should increase the rents about $200 to $250 per unit. And that's assuming, hey, great, we're leasing up in prime time, so we get maximum rent. Then should see an extra $200 to $250 a month in rent, which translates into $36,000 to $45,000 annually. Now, of course, they have to pay some money on that, to the property management fee. They'll also have a little bit more maintenance and reserve because they got to take care of washer and dryers and ACs now and all that. But for the most part, that's almost, just a lot more profit at the end of the day. That'll put money back in their pocket. So that can increase their cash flow easily from $25,000 or more a year. So a very, very significant cash flow increase that might be a 3 or 4 year payback period on the money they spent. So in the long run, it makes a lot of sense. But the other great thing about this is since this is an income property, so it's more than 5 units, that's how they value these as income properties, is that since the rents increase and the expenses don't go up nearly as much, it increases your net operating income or your NOI. And since they use NOI to often determine the value of the properties, it could have a $500,000 or greater equity bump in the property. Now, they may use it, they may not, but more equity is usually not a bad thing to have. But sometime down the road, 8 years, 9 years down the road, when it comes up time to refinance out of their 10-year term, hey, between that and increasing some rents overall, they might want to pull out a significant chunk of money from there, a few $100,000, if not more. And if you got an extra $400,000 you can pull out of there, well, that's a whole other down payment on buying another multi-building. So this isn't like the quick burst strategy that people talk about, but this is where if you've got the patience and you play the long game, there's a lot more opportunities like this to help really build that long-term wealth, and that's what their plans are doing. So Preston, that's all I got on my list. You got any closing thoughts?
Yeah, I just wanted to, kind of circle back around, being that our client was coming from a market with much lower returns, this was a really fun deal to work on, and they were really, really happy at the end of the day. I kind of feel like, this was almost a home run in their book because the upside here, the cash flow, right away is really good. But again, the upside here and the potential to really make some money on this is there for them, and that's something that really excited them. So overall, this is a really fun transaction and something that we really enjoyed. Obviously, this is the first time we've done a unit this big and learned a lot as we went through it, but I definitely enjoyed it.
Yeah. All right, everyone. Thank you for listening. If you got questions on here, you want to understand the details of how to underwrite bigger apartment buildings, you're looking at doing 1031 exchange yourself, reach out to us. This is what we do. More than glad to sit down with you and walk you through the details and help you find a property. All right, everyone. Thank you for listening. And Preston, thank you.
Thank you, Chris.